that you might not be used to it in PM. Sorry, let me just forward some of these things to the platform. So pricing decision is important for so many reasons. Is important for so many reasons. So because price will determine the contribution per unit and volume of demand that will accrue to an organization. With a target profit, the primary factor is that you produce. So the price will determine the volume of demand, because we all know that the higher the price, the lower the quantity demanded. And the higher the price, the lower the quantity demanded, and the lower the price, the higher the quantity demanded. So to determine the volume of goods and services, the price is a determinant. So price influence both profit and cash flow in an organization. Price influence profit and cash flow in an organization. So there are various factors that determine the pricing policy in an organization. Number one is the objective of the organization. Are you running an NGO, or you want to maximize profit? So what is your objective? What is your strategic goal? What is the corporate goal of your organization? So is a determinant of price in an organization. And also, another determinant of price is the organizational structure. Are you running a centralized structure, decentralized structure, or a divisionalized structure? So these are factors that determine price, because when you run a divisionalized structure, it means there will be a transfer of goods between division A and division B. So the internal transfer pricing policy is likely to affect the price of your finished product. So also the nature of the organization products. Now we have various forms of products. We have luxury goods, we have gifting goods, we have consumer goods. Yes. So the nature of your product will also determine the price. And one key factor that determines price also is the actual cost of manufacturing a product. The actual cost of manufacturing a product also determines the price to be fixed for a particular product. So there are so many factors that determine price. And I'm just using this as a background, as I'm still trying to send the links to the platform. Let me just do that at once. All right, speaking to this slide now, that an important decision for the management accountant is that of fixing a selling price. So in this class, we will consider the practical considerations that are likely to apply and also some theoretical calculations that you need to know. So factors influencing selling price, that many factors are relevant when considering what price to charge. So the main areas to be considered are the following: that is the cost, competitors, customer. The cost of production is a determinant of price to be fixed in an organization. Now, when you have varied amounts of competitors, for you to penetrate the market, for you to create a niche for yourself in the market, you need to understudy your competitors and see what price will be favorable to you for you to be able to make a good sell in terms of your product. Now, also in relation to customer, you must look at the purchasing power of your customer. You must look at the classification of your customer. Which group, which segment do they belong to? So these factors will determine the price to fix. Now, to some customers, if the price is cheap, they might see the goods as being inferior. That is to some persons. To some persons, it is when the price is high that they appreciate the goods, even when the goods, the quality of the goods is actually not at its best. So factors that influence price, we have the costs, competitors in the market, we have customers, and every other ones I've mentioned, the corporate objective of the organization, the nature of the organization structure, the nature of the company's products, the actual cost of manufacturing the product are all factors that influence price. Now, there are various forms of pricing policy. There's what we call cost plus pricing. Cost plus pricing. That is for you to fix your price. You sum up the costs with a markup percentage on the cost of the goods. So using cost plus pricing, the selling price is calculated by estimating the cost per unit of a product and adding an appropriate percentage, that is a markup. So a primary consideration would be as to what is to be regarded as the cost. So the concept here is, what is the definition of cost? Now, costs can be in terms of full cost, marginal cost, or opportunity cost. When we talk about full cost, we're talking about the aggregation of your fixed cost and your variable cost. The sum of your fixed cost and your variable cost, when they are put together, they form the full cost. The marginal cost is considering only the variable cost, only the variable cost in the question. And the opportunity cost is what is forgone to actually produce a product, the sacrifice made. Now, talking about the full cost plus, full cost includes a share of overhead and also often includes non-production cost. Non-production cost. And the marginal cost plus entails the price of the product being determined by calculating the marginal or incremental costs of producing a unit. That is the variable cost. Variable costs are costs that varies with the production. So when you determine the variable cost in the question, now a percentage will be given as a markup. You compute that percentage on the cost, the variable cost. You add to the cost to determine the selling price. And the opportunity cost plus is a marginal cost approach, but also includes within the cost any opportunities forgone. So this is a relevant costing approach. Relevant cost is also a topic that you need to read on. I think in the last exam, there was a question related to that. Life cycle costing, relevant costs, and so on and so forth. So looking at this example, I will not solve this example. I will expect everyone to solve and give me your respective answer. The question is, a new product is being launched. A new product is being launched, and the following costs have been estimated. We have materials, $10 per unit, labor, $8 per unit, variable overhead, $5 per unit. Fixed overhead have been estimated to be $50,000 per year, and the budgeted production is 10,000 units per year. Calculate the selling price based on full cost plus 20%. Calculate the selling price based on marginal cost plus 40%. So, looking at this question, why I'm saying I will not solve this is because this is elementary. For somebody that is preparing for ICANN, May diets, you should have, this shouldn't be headache at all. This should not be any issue at all. So to compute for full cost plus, based on my earlier explanation, that you sum the total costs, both the variable and the fixed, and apply a percentage of the cost plus to determine the selling price. So can we quickly solve? Can I get a response? What will be the full cost plus?
$33.6.
Okay. 33.6. Yes. Any contrary?
336,000.
Okay, 336,000. Okay, you didn't work per unit, right?
No, I did not work per unit.
Yes, that is why you're having that. So can you work per unit?
Okay.
33.6.
3.3.
Yes.
33.3.
Yes, 33 points.
3.
33 points.
33. Mine is 33 points.
33.
Yes, it should be 33.
6.
Yes, 33.60.
33.6.
Yes. So that is it for full. Yes, that is it for full cost plus at 20%. Now for marginal cost plus at 40%.
Sorry, sir. Some of us seems to be lost here. Can you please assist?
For full cost plus, the overall cost to produce a product, material is $10. Labor is what? 8. Variable overhead is what? Is 5. Is 5, right? Now, fixed overhead is not given to us in units, but per year. Now, from the question, how many units are you to produce per year?
10,000 units.
10,000 units.
Get fixed overhead per unit. It will be what? 50,000 divided by 10. You have it as what?
5.8.
5. No, that would be 5,000.
You have it as
per
5.
unit. That would be $5.
$5. So when you add
$5
$5, when you add the whole cost, 10 plus 8 plus 5,
23.
plus 5,
23.
with respect to the fixed overhead per unit,
28.
28. Then the 20% on that will give you what?
Okay.
5.6. The selling price will be what?
33.6.
So that is a full
unit.
cost approach.
Thank you.
That is the full cost approach. Now,
Thank you.
working based on the marginal cost plus. the marginal cost plus, the result will be what?
32.2.
32.2.
32.2. 32.2.
32.2.
Okay. So how do we determine that? Marginal has to do with variable cost. The variable costs in these questions include 10 for material, labor for $8 per unit, and variable overhead is what? 5. So these are the variable costs in this question. So the total variable cost, marginal cost is what? $23. So when you apply 40% on that 23, you have a profit margin of 9.20. Now, when you add that profit to your cost to determine, you'll be able to determine your selling price. And this is it. I'm not solving this step by step because I just want to assume that before you solve transfer pricing, I think we've treated transfer pricing with the other tutor. And even in a video I forwarded, a link I forwarded to the group where I was talking about transfer pricing likewise. I think I do explain this. So that is why I don't want to waste my time on all this. Yes. So, because divisional performance, transfer pricing, all these are discussed in that topic. So that is why I just want to run over this. So for the marginal cost plus, I believe everybody should be okay with this solution. Is material is 10, labor is 8, variable overhead is 5, sum everything, the marginal cost is 23. Now 40% of 23 will give you 9.2. When you add to the marginal cost, you have your selling price to be 32.2. Yes. So we have optimal pricing. Optimal. Now, when we talk about optimal, what do we refer to? When you say optimal, from the word optimum, optimal pricing.
Okay, can I answer it?
Yes, very well.
Okay, to my best of my knowledge, optimal, that is the best pricing. The best. I think so.
The best. Okay. All right. Optimal pricing is the price point that maximizes an organization's profits while maintaining a balance between demand and supply. So it considers factors like costs, competition, the consumer behavior, and the market condition. So the optimal pricing is the price where you have the highest profit. So we'll be considering this, looking at this in a tabular approach, then we'll move to an equation aspect. Now, one major disadvantage of a cost plus approach to pricing is that it completely ignores the possible effects of the selling price on the level of demand. So for many products, but not all, it is the case that a higher selling price will result in lower demand and vice versa. It could therefore be worthwhile to reduce the selling price and sell more, provided, of course, that this resulted in a higher total profit. Now, I believe you all know the law of demand and supply. Yes, you should know that, right? It's elementary. The law of demand states that what? That's
The higher the price. Good evening,
The
sir.
price.
The
The
higher
higher
the
the
price,
price, the lower the
the quantity
quantity.
The
demand.
quantity. Why
yeah,
the lesser the price,
The
the
lower the
higher
price.
the quantity demand.
yeah. So that is it. I don't want to start. You see, those days in secondary school, we used to sing with it.
But what about supply, sir? So the one they just mentioned is only demand now. So what about the supply?
Supply, the
The
higher the
higher
price, the higher the quantity
the,
supply.
the lower the
Supply is the higher the price, the higher the quantity supply. The lower the price, the lower the quantity.
Okay, thank you.
All right. As a consumer, let me speak on that. As a consumer, you'll be happy when the price of things are low. And when they are low, you want to buy more. That is to we consumers. But when the price is high, the way it is now in our country, we grumble. And when the purchasing power is not there, we buy less. So the law of supply state that as the price of goods and services increase, the quantity supply will also increase. And as the price decreases, the quantity supply decrease. So assuming all factors remains constant, that is ceteris paribus. Yes. So to you, the supplier, the producer, when the price is high, you want to sell more to maximize profit. But when the price is low, you'll be discouraged to produce. So I'll respond to all these and write up when I'm through with my class. I don't want to get distracted. Now, we have this question. Kennedy PLC established that the price-demand relationship is as follows. The selling price per unit. We have demand. When the selling price per unit is 16, demand is what? 100. When selling price per unit is 15.5, demand increased to what? To 200. When selling
200.
price reduced to 15, the price increases to what? 300. When selling price
300.
reduced to 14.5, the price increase, the demand increases to
400.
400. When it
400.
reduced to 14, quantity demanded increases to what?
500.
500. And when selling price reduced to 13.5, demand increased to 600. Selling price reduces to 13, demand increases to what? 700. So you can see the law taking effect here, that the higher the price, the lower the quantity demanded. The lower the price, the higher the quantity demanded. So they have also established that the cost per unit for production of jars of coffee is as follows. That is the cost of production now. Quantity, when the cost per unit is 14, the quantity produced is what? 100. When the cost per unit is what? Is 13.9, quantity increased to
200.
200. When the cost per unit is 13.8, quantity increased to 300. So in that order, now determine the optimal selling price in order to maximize profit. So in every questions that you always see, once they're talking about profit, two things should come to our mind. Two things. And what are those two things? It means selling price and what? Cost. And to take it further, it will be total revenue relation to what? Total cost. Total revenue in relation to total cost. Now, to solve this, to determine the optimal selling price that will maximize profit, we'll need to compare our total revenue at every level of demand to the total cost at every level of demand likewise. So determination of the optimal selling price. Now we have the selling price. You just draw a table because we're trying to use a tabular approach at this point. We have our table. We have the selling price. You put this yourself. Selling price, demand, the cost per unit, the total revenue, the total cost, total profits, marginal revenue, marginal cost. Now, your total revenue will be what? Will be your selling price multiplied by demand. Your total cost will be what? Will be cost per unit multiplied by the quantity produced. Now, your total profit will be the difference between your total revenue and your total cost. Now, talking about marginal revenue, when we talk about marginal revenue, what do we refer to? Marginal revenue.
That is the additional revenue
Additional
derived.
derive.
Yes. So marginal revenue, marginal utility, marginal cost simply means the addition. Yes. Marginal revenue is the additional revenue a firm earns by selling one more unit of a good or service. If it is marginal cost to, it's simply the additional cost incurred by an organization to produce one more unit of a good or service. So it's most times denoted by change in total revenue divided by change in quantity. That is marginal. Or sometimes it will be present revenue minus previous. Now, going by this question, you can just screenshot this question. If you are using your phone and your laptop, anyone can screenshot so that you follow as I try to fill up the table. Now, we have selling price.
Sir, please help us with the question again. Thank you, sir.
Please, if you know your background is noisy, just mute yourself.
Olai, then mute yourself.
So you can still mute them now because some of them might not be there.
No, I'm trying to
Just mute
send.
them.
I'm trying to do something. That is why I know I can mute
Okay.
them. I'm trying to
Oh.
send the YouTube link to some other groups I've not forwarded them to.
Temitayo, mute yourself.
Hi.
All right, I think I'm back now. Yes. So, looking at this question, I believe everybody, we're all having it now. The selling price, we have the selling price at 16. At that point, the demand is what? It's 100. We have a selling price of 15.5. The demand at that point is what? 200. At the selling price of 15, the demand is what? 300. At the selling price of 14.5, the demand is what? 400. And at the selling price of 14, the demand is 500. At the selling price of 13.5, demand is 600. And at the selling price of 13, the demand is what? 700. So we have the costs likewise. Now we don't have issues with 800 and 900 quantity because we don't have corresponding demand values related to them. So in terms of the costs per unit, we have 14 in relation to 100 units, and also we have 13.9 in relation to 200, and we have 13.8, we have 13.7, and we have 13.6, we have 13.5, and we have 13.4. Now the total revenue will be what? When demand is 100, the total revenue will be what?
1,600.
So the total revenue will be 1,600. That is selling price multiplied by demand. That is 16 multiplied by 100. You have 1,600. And when demand is 200, the selling price, the total revenue will be what? Should be 3,100.
1,100.
3,100.
Demand is 300. Total revenue should be
3,100.
1,500. And when the selling price is 14.5 and demand is 400, the
5,008.
5,800, and this should be 7,000,
7,000.
and this should be 8,100. This should be 9,100. So in relation to cost now, the cost per unit is 14 when demand and when
1 4.
production is 100. So we have it as 1,4. And the next 13.9, we have it as 2,780, and this will be 4,140, and this will be 5,480, and this will be 6,800, and this will be what? 8,100, and this will be 9,380.
Now you guys can mute yourself now. Eh?
Sorry, Mr. Felix, mute yourself now. Please.
All right, so the total profit would be what? When selling
200.
price is 16, total
200.
profit would be revenue minus cost. Revenue minus cost, 16 minus 14, you have it as 200. When the selling price is 15.5, the total profit
320.
is what?
320. 320.
20. And at this point, we have it as 360. And here we have it as 320. At this point, we have it
200.
as 200.
1,000.
And at this
1,080.
point, we have it as
200.
0. And at this point, it should be a
Negative
negative
280.
280. So if you are asked now, the question is saying, determine the optimal selling price in order to maximize profit. Now, at what selling price are we going to have the best profits?
At
15 naira.
15.
15.
At 15 naira.
15 naira.
So at 15 naira, we have the optimal profit. So the optimum selling price will be $15.
Naira.
$15. Yeah, so I just put this marginal revenue and marginal cost because we still need this concept as we move on. So marginal revenue, when the selling price is 16, will be what? Present minus previous. Present minus previous. It means the present revenue as at this point is what? 16. The previous is what? 0. There is nothing there. So 16 minus 0 is what?
16.
16. Now, when the selling price is 15.5, the current revenue is what? 31. The previous is what? 16. 31 minus 16, you have what?
1,005.
Should be 15. Now, when the selling price is 15, the present revenue is what? 45. The
5.
previous is what? 31.
14.
Marginal revenue is what?
14.
14. When the selling price is 14.5, the current revenue is what? 5,800. The previous is what?
13.
5. So these will be what?
13.
13.
13.
When this selling price is 14, The current revenue is 7,000. The previous is what? 5,800.
One,
Two, two,
What?
one,
one, two.
1,200. So I expect everybody to have come along and know what to do.
one,
One,
that
two,
one,
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 two,
one,
one, two.
1,000.
So the marginal cost, same approach applies. In terms of cost, when selling price is 16, the total cost is 1,400. 1,400 minus 0, you have 1,400.
One, four.
When selling price is 15.5, the total cost is 2,780 minus
1,380.
so we have it as 1,380.
1,380.
So I expect
Oh,
so this will be 1,360. This should be 1,340, and this should be 1,320, and this should be 1,300, and this should be
288.
1,280. So this is still very elementary. This is still secondary school work. Yes. So this is still elementary. This is now let's take it further. Let's take it further.
Before you go too far, please can you come back to the marginal revenue and the other revenue? I joined late.
All right. So what's just tell me what is the question in terms of marginal revenue and marginal costs? Just ask your question.
I mean, how do we get the values on that the marginal revenue?
Now this is it. Marginal means addition. Now for you to get the marginal revenue, it is present revenue minus previous. Present minus previous. So now, from this question, the total revenue here is what? 1,600. 1,600. When selling price is 16, the total revenue is 1,600. What is the previous revenue before 1,600? It's 0. 1,600 minus 0 is what? Is 1,600. When the selling price reduced to 15.5, the total revenue is what? 3,100. Because when it reduces, you are selling more. People are willing to buy more, so you have more revenue. So 3,100. Now the marginal revenue will be what? This is the present as at this point minus the previous. The previous is what? 1,600. 3,100 minus 1,600, you have what? 1,500. 1,500. When the price reduces again to 15, you have more revenue. You have more revenue at the price of 15. As at this point, the current revenue is what? 4,500. The previous is what? 3,100. 4,500 minus 3,100, you have what? 1,400. So I don't know if you are clear with this.
Clear with that, sir. I'm clear with that.
So you keep doing it till the end. Same for marginal cost.
Okay, understood.
Now we'll move to this price.
Sorry, sir. Sorry, sir. I've been raising my hand.
All right.
Okay, thank you. Yes, sir. The question is, they say determine the optimal price. So now, among all those lists of prices now, which of them is the best? As in the optimal price, the optimal selling price. Which of them is the optimal selling price?
Okay.
Thank
We answered the question earlier on, but let me just put a write up to that. The question now will be, why 15? Why 15? So can you just look at the price of 15? The total profit is what?
360.
360. So when you compare 360 with the other levels of profit, what will be your interpretation?
It means that
Three,
is the highest profit.
yes, it's the highest profit. So that is why it's at the selling price of 15 will make the highest profit. Hence, that will be the optimum selling price of the optimal selling price.
Okay, thank you very much.
Let's take it further to price elasticity of demand. We have various forms of elasticity of demand. Yes, when these class, we look at the price elasticity. Yes, sorry, I earlier said I was using my phone, so some calls will come in and disrupt my network. So kindly bear with me, though I will not pick the call. So can I get two definition of what elasticity of demand is? Somebody, I was teaching this topic and somebody was telling me those days in their secondary school, the tutor or the teacher used rubber band, stretching rubber band, that was using that as an illustration. So maybe somebody will tell me same thing. So what is elasticity of demand? Let me hear.
So my own understanding, sir. Good evening, sir.
Good evening, sir.
Percentage degree in change in price
Okay.
over percentage change in demand.
Okay. 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 All
Okay,
right.
can I say something? Yeah.
Yes.
Okay, it's a persistent change in demand over change in price. Persistent.
Okay. Persistence. Okay. All right. I still one word I'm looking for. I've forgotten the name
Constant
of
change
those.
in demand. Constant change in demand over constant change in price.
Okay.
Is
People
it
are not
degree?
giving me.
Is it degree
Are
of
not giving
Are
me
you
that.
degree?
looking? Are you looking for the something like responsiveness, something like that?
Yes.
Is it the
Degree
Yes.
of
That is the
responsiveness.
word.
Degree of responsiveness.
Yes, that is the
Yes.
word.
So you guys have to give me gift too.
Those days they always define elasticity of demand as the degree of responsiveness of change in quantity demand due to change in price. Yes, the word responsiveness is always ringing bell. Yes, so there are various forms of elasticity of demand. We have unitary, we have perfectly elastic demand, perfectly inelastic, and when it is unitary, it means the result will be one. Yes, so when you go to the ICANN study pack, you read this topic, you see most of these things there. I know most of us are not, you are not even using your ICANN study test, so I was looking at it and I was seeing most of these things there. So it's very important to study it. I can just go and pick a question from that point because they know you might think it's too elementary, but there's nothing that is elementary. So you go and study it and see what is there. So in the previous example, a reduction in the selling price results in an increase in demand and vice versa. So this is true of many products, but the effect of selling price on demand will be different for different products. You know, still on the concept of demand, there are various types of products. We have inferior goods, we have gifting goods. Gifting. I believe you know the word what gifting goods are. Anybody with the idea? Inferior goods and gifting goods. Now, let me just give a little talk on that. When we talk about inferior goods, these are goods which demand decreases when the consumer income increases. Now, there are some things you would like to buy now, but as your income increases, you see those things as am I the one buying these things? Am I the one putting on these clothes? You understand? Because your purchasing power have increased. So you tend to do away with such goods that you were buying when your income is low. So you see such goods as being inferior. So there are goods which demand decreases when consumer income increases, and demand increases when income decreases. So, for example, when your income is still low, you are going with public transport. But now that your income have increased, you can have a ride of your own. So, and also when we talk about gifting goods, this is a rare type of inferior goods where demand increases even when the price rises. Things like gold, yes, they are gifting goods. So it violates the law of demand. As the price increases, people are buying more of it. So it does not follow the law of demand. So there are special products, special goods that violate the law of demand. So those are gifting goods. So the effect of selling price on demand is also likely to be different for the same product at different level of selling price. So a measure of the size of the effect on demand of a change in selling price is called elasticity of demand. It means that when price changes, what is the reaction of consumers towards the price change? If price change from 2 naira to 10 naira, it means demand should fall in that same proportion. But when price changes from 2 naira to 10 naira and demand refuses to change, refuses to fall, it means the product is a very important one and demand is inelastic. But when price changes and there is a high change in the quantity demanded, it means demand is perfectly elastic. So the results you determine if it is perfectly elastic. If it is perfectly elastic, it means the result is more than 1. If it is inelastic, it means your result is 0.0 something. And when it is unitary, it means your result is 1. Your result is 1. So for you to determine price elasticity of demand, the formula is percentage change in demand divided by percentage change in price. Percentage change in demand divided by percentage change in price. The question now is, how do you determine percentage change in demand? Can anybody recall? Percentage change in demand.
Yes.
Mhm.
Yes, I think is the
Q2,
old minus
Q2,
2 divided by the
Q2
new.
minus
Q1 divided by.
Okay. I have some strong economics in this class. I can still recall what their teachers were telling them those days. Yes, different textbook with different approach. Yes, they will say Q1 minus Q2 divided by Q2. So, in simple term, percentage change in demand. Please write it down because it's not on my slide. Percentage change in demand is old quantity minus new quantity divided by new quantity multiplied by 100 for 1. That is percentage change in demand. That is percentage change in demand. Why percentage change in price?
Sir, please recap.
Come again.
Percentage
Recap.
change in demand is old quantity minus new quantity divided by new quantity multiplied by 100 over 1. Let me just show it. So please divide by new quantity. And divide it and multiply by 100. Yes. So you can do for percentage change in price is old price minus new price divided by new price. Percentage change in price is old price minus new price divided by new price. So a high price elasticity of demand means that the demand is very sensitive to changes in price. It means that if price changes from 2 to 3, 2 naira to 3 naira, and there is a high decline in the quantity demanded from, let's say, 10 to 4, it means price have great effect on the quantity demanded. So it means elasticity of demand is very high. It is perfectly elastic because when you compute that, you discover that your outcome will be greater than 1, and hence the result can be interpreted to be perfectly elastic. But when the result is 0.01, so it is inelastic. It means the change in price does not have great effect on the quantity demanded. So let's look at this example, that using the figures from the earlier example where we use the table, calculate the price elasticity of demand. If the current selling price is $16 per unit, that is 1. Also, we'll calculate if the current selling price is $15 per unit. Now, going by this example, going by this same question, that we should calculate elasticity of demand if the current selling price is $16 per unit. Now, if the current selling price is $16 per unit, what is the old selling price? If the current is 16, the old is what? 15.
15 point.
Zero.
Zero.
5.
No, it's 15.5. 15.5. This is the old. This is the current. If the current is 16, the old is 15. The old is 15. Yes, you know, why I was even talking about revenue change. You know, this is the present and there is no previous. So this is the old and this is the new. Yes, because the question, we just follow the question that if the current selling price is $16, if the current selling price is $16, we are to calculate the elasticity of demand. It means that this is the new, this is the old, the old. So for you to compute that now, if the selling price, if the current is 16 and the old is 15.5, what will be the price elasticity of demand? From this formula, the first thing you have to determine is what? Percentage change in demand divided by percentage change in price. Now, from this question, the percentage change in demand would be what? This is the new, right?
Mister, this
So
question is somehow confusive because when the price was 16, we don't
Yes.
have the figure, we don't have the price before 16. And from the illustration given to us here, as the
Yes.
price is here, the demand increases. So from 16, when the price is 16, the demand was is 100. When it was 15.5, it increases to 200. Then when the price is 16, when the current price is 16, how are we going to differentiate that? Okay, this is the old and this is the
Yes. The question made it clear that the current price is 16, right? What we're just trying to do, we're trying to make reference to this table. In some other question, they'll make it clear that the previous price is this and the current price is this. You understand? But regarding to this now, that the current price is 16.
Hello? Hello?
Yes,
Can you hear me?
I can hear you.
I'm thinking the formula we use here is supposed to
Yes,
be new minus the old all over the old.
new minus old.
Yes, all over the old. I think that's where we are missing it up.
Okay. Anybody backing that up?
Yes, I think so. Yeah.
I second that also.
Sir, please, can you say the formula for the percentage change in price again so that we'll understand? Because if I could get you clearly, you said the old price minus the new price.
Yes. Let me see.
I think it should be new minus old.
Okay. Okay, yes, it is.
If you are to use old minus
Sorry,
new, this should
it's
be
new.
a negative
It's
answer.
new
New
minus
minus
old.
the old all over the
Though
old.
negative is insignificant, we ignore it anyway, but let's put it right. Yes. It's new. Wow.
Please, can you mute?
Yes, it's new quantity minus old quantity divided by old quantity multiplied by 100.
Sorry, sir. Does it apply for same with price?
Yes, it applies. Yes. New price minus old price divided by old price. Yes. So now, thank you for that observation. So going by this question now, if the current selling price is $16 per unit, what will be the price elasticity of demand? The price elasticity of demand. If the current price is 16, so it will be what? It will be the old minus new divided by what?
New minus old, sir.
Okay, new
minus old all over the
yes,
old.
yes, new minus old all over the old.
Yeah.
So now, in terms of the demand now, going by this formula, change in demand, what will be the percentage change in demand? In terms of the demand. The new is what?
0.5.
It should be 3.2.
3.33.
3.33.
I got 3.22.
Okay, so let's see it for the demand. The new demand will be what?
Will be 16.
No, this price for demand now.
200.
100.
No demand is
New
100.
demand,
100. 100.
New
100.
demand is 200.
The new demand, let's look at it again. Say it here. The new demand that the current, see the question, that if the current selling price is $16 per unit, the current, that is the new, the current 16 is the new. So now, if the current is 16, it means the current demand is what?
It's 100, sir.
100. The current demand is 100. So now, based on this formula now, the new quantity will be what?
200.
The new quantity will be 100. Why the old will be 200? Our current demand is 100. Why our old demand will be 200? It will be 200 minus 100 divided by 200.
So we have it as this. So based on the formula, it will be the new quantity minus old quantity divided by the old quantity. So the new quantity is what?
It's 100.
100.
The old quantity is what?
200.
300.
See. Divide by the old quantity.
But sir, your formula seems to be different. What you gave was old quantity minus new quantity. But you are
Let's
using
change
new
it
quantity
now.
and
No, we've
He
changed it.
has
We've
changed
changed it.
it.
okay,
We've
thank
changed
you.
it. Yes. Okay. All right. So if the current selling price is 16, if the current selling price is 16, the demand corresponding is 100, and the change 15.5 in relation to 200. So now the percentage change, the new quantity will be, sorry, just look at it this way. The existing price is 16. Now, let me make it this way. The current, this current, this is the old. And let me make it this way. This is the new. Yes, please note it this way, please. This is the old. This is the new. So now, based on the formula, the new quantity.
Sir, excuse me.
Yes?
Please, let's go back to the table. Okay,
Yes, we
sir.
are
You
there.
indicated that the 16 is the old price, but on the question, they say that the current, when the current selling price is 16.
Yes. The
But
current.
on the table, you stated that the 16 is the old price.
Yes. This is it. That the current is 16. Now, it means there is a change. There is a change from the current to a new one. To a new one. It means there is a change from 16 to 15. There is a change from 16 to 15. It means there is a decrease from 16 to 15. So that is why I'm making the current is 16 and the new is 15.5. 15.5.
Okay. Okay, now
Sorry, sir.
coming to the demand.
Sorry, sir.
Yes,
From the
yes.
question we read now, it means the 16 we have been given is the old price.
Is the old price.
Okay.
Is the old price, yes. Is the old price. So
Sir,
in
but
relation
they
to the
stated that is current.
I don't think
Is
so. I think
present
16 is the new price.
Current is present.
I think the way you are doing it earlier was right. 16 is the new price, while 50.5 is the old price, which at the end you should get minus 0.5. I believe you are correct in the first way you're doing it.
No, that is wrong. Yes, this question, I've solved it and I've tested it. Yes, so this is how it works. Yes. If you solve it the other way around, let's see. Yes. So
that's minus 0.5.
Yes, that is wrong. Yes. Before coming to this platform, I've solved this question. Yes. So I'm just giving room for ideas now. So now, and I've tested it, yes. So it's the old is 16, the new is 15.5 in terms of the selling price. The demand in terms of old is 100, and in terms of new is 200. In terms of new is 200. If you work it the other way around, saying that 16 is new, you discover your answer will be distorted. So try it on your own and see. So
Working on it that way, when working on the price, we get a positive answer. But when working on the demand, we get a negative 100.
yes, when you get a negative figure in solving for elasticity, you ignore the negativity. You ignore the negativity. So when you solve for price, you get a negative figure, but it is being ignored. Yes, when solving for elasticity of demand. When solving for elasticity of demand. So, but what is your
Sorry,
answer?
sir. I have a question, sir.
Yes, yes. I don't have time. Yes.
Assuming in
Yeah,
the
very
situation
fast.
where we are being given where we are be giving a old price and new price, it will be simple. But because it is on the table like that, that's why it is giving the problem like that, sir.
Okay. So please, the sorry, somebody is chatting me. Sorry, let me just move on. Let me see. Let me move on. You can compare with the ICANN study pack. Yeah, somebody is just trying to chat me that. So please, the new quantity will be 200 minus the old quantity, which will be 100, divided by the old quantity, which is 100. Now, when you solve this, when you simplify this, you have what? This is for the percentage change in quantity. For
We
percentage,
have 100.
The answer
okay,
is 1.
fine, fine. For percentage change in price, it will be 15, 15.5 minus 16 divided by 16. Take note, this is a division here. So when you divide this, you have what? When you
Minus
simplify all this,
minus 3.125.
3.125.
so the first result up was what? Somebody said 1.
1.
100. 100
When
because
you,
you multiply by 100.
so divide by what? Divide by the numerator.
3.125.
3.125.
3.125. So when you simplify, you have what?
32.
32.
You have
32.
32. You have 32. So that is the result, 32. 32. So, but this is not where we are driving to actually. So when you solve, if the current selling price is 15, let's assume now the current selling price is 15. What would be the price elasticity of demand? If the current selling price is 15, if the current, this is the old now, what would be the price elasticity of demand? If this is the old now, what would be the new?
14.5.
14.5.
14.5. So can you quickly solve? What will be the result? The price elasticity of demand.
Three point three three.
Yes, you compare with this.
3.44.
You compare with demand likewise.
Hundred. Demand is 100.
Yes, you compare percentage change in demand divided by percentage change in price.
I got minus 3.5.
Wow, serious. So this is how it is. 400 minus 300 divided by 300. This
I have 33.33.
14.5 minus 15 divided by 15. When you simplify, you should have what?
Divide by 14.
me simplify this. You have what?
Yes, 3 points.
3.33.
3.
3.33.
Yes.
Yes.
3.33.
Overall.
100 divided by 3.3.
1. We have 1.
1K. Overall is 10.
30.03.
Yes,
The overall
overall is
answer is 40 points.
oh, please.
30.03.
If you are not getting 10,
Overall answer is
you're not
10.
doing the
It's
right
10.
thing.
It's 10. Where is going to get our own now? Overall answer is 10.
If you are not
It's
getting
10.
10, you are doing the right thing.
It's 10. 10.
Yes.
10 is the answer.
It's 10. Try
Yes.
3.33 divided by 3.33. Yes.
It's 10.
Yes.
Okay, it's 10.
Please check your message.
Yeah, I've seen my message. I've seen it. So let me see.
Sorry, sir. From what we calculated now, is it perfectly inelastic or perfectly elastic?
It's
It's
perfectly
perfectly
elastic.
elastic. Yes, I saw your message. The person that
Perfectly
sent the
elastic.
message to me is still the same thing we are doing. Yes.
Sir,
So
please, I'm not getting 10. Oh. The answer is not 10, please.
please, can you just take your time and
Yes,
solve
sir.
it well? It's 10, please.
All right.
Take your time. If you are not punching your calculator or you are not following the law of board mass, you will not get it. So please.
Okay, sir,
Just,
share the slides to the group so that we see the question very well and solve after the question.
so
Thank you.
I don't have time. I have limited time. So the person that sent a formula to me is still the same formula, please. Yes.
Yeah, it's
So
the same formula,
optimal
but
pricing equations. Optimal pricing equation. So in one of the previous slides, we presented the price to demand relationship as a table and use these figures to calculate the optimal level of selling price from those available. So in principle, it will be possible to have an equation relating the selling price to the demand and then solve them algebraically. Yes. So this is the major point I'm concerned about majorly. Now we have what we call the price to demand equation. In the exams, you could be asked to derive the price to demand equation yourself from information given, or alternatively, you could be given the equation. So if you were asked to derive the equation yourself, then it will always be on the basis that the relationship is linear. So looking at this graph, we can see this is a demand curve showing that when the price is high, the quantity demanded is low. As the price reduces, quantity demanded increases. So that is what this graph is showing us. So the equation will therefore be as price is equal to A minus BQ. Price is equal to A minus BQ. So a linear equation is an equation that represents a straight line when plotted on the graph. So the equation is for price is P is equal to A minus BQ. What is P? P is equal to what? The selling price. What is Q? Q is quantity demanded at that price. And A is what? Is a theoretical maximum price. If the price set at A, or above, then the demand will be 0. So A is the price when demand will be 0. A is the price when demand will be 0. So if you are given a question, can be given a price. So, and you'll be asked to determine the value of A. The value of A is the point where demand will be 0. It will be a higher price compared to what is given in the question. And B, the B is the change in price required to change in demand by 1 unit. That is the gradient, the slope of the line. So let me interpret this A very well. Let me interpret A very well, because when we're trying to solve a question, we won't get confused. Just put it this way. P is equal to A plus BQ. P is price. So A is the price when demand is 0. When demand is 0.
Balogun, stop presenting.
So A is the price when demand is 0. So at the maximum price, demand will be 0, because consumers will not want to buy at that price. Demand will be 0. So to get A in an equation, A will be equal to the current price given in the question, current price plus the value of B. The value of B will be change in price divided by change in demand. Change in demand multiplied by actual quantity. Putting it this way, so that when we start solving question, we'll not get confused. So A is current price plus change in price divided by change in demand multiplied by actual demand. Now, from this, what is B? B is what? Change in price required to change demand by 1 unit. So B is this way. B is equal to change in price divided by change in demand. That is B. Change in price divided by change in demand. That is the elasticity. Please take note of this. Take note of this breakdown. Let's look at this example. That a company sells an article at $12 per unit and has a demand of 16,000 units at this price. If the selling price were to be increased by $1, it is estimated that demand will fall by 2,400 units. On the assumption that the price stroke demand relationship is linear, derive the equation relating the selling price to the demand. That derive the equation relating the selling price to the demand. Now, the equation, the price equation is P is equal to what? A plus B, Q. Now, based on this question,
5 minus.
okay, it's minus, sorry. So based on this question, the value of A is what? To get the value of A,
The current price plus change in value, change in price over change in demand multiplied by actual quantity.
yes. So to get the value of A, the current price in the question is what? It's 12.
$12.
$12. $12.
The current price is 12.
$12.
12. Now I define A, that A is what? Current price plus change in price divided by change in demand multiplied by actual demand. The change in price divided by change in demand is what? What are the various changes?
Changing the price is $13. While changing
No.
demand,
If the selling price is to be increased, what is the increase?
Is 1.
1.
1.
And
increase by
demand will be
1.
what?
Increase by
2,500.
2.5.
Yes, it means if price is increased by $1, demand will fall by what? 2.5.
2005.
Demand will fall by 2.5. So the change, the relationship between $1 and 2.5 will be what? The relationship
It's 2.5.
between $1 and 2.5 will be what?
Changes in price. 5.
0.00
0.0004.
0.004.
Everything
Yes.
will be 1.56.
All right. So 1 divided by 2.5.
2.5.
The actual demand in the question is what?
16.
16,000.
16,000.
16,000. So multiply by 16,000. So we're going to have what now? The A will be what?
0.156.
6.4.
A will be 12 plus
18.4.
6.4. So A will be what?
6.4.
A will be what?
18.4.
18.4.
18.4.
Yes. So the value of B is what? Will be what in the question? B is change in price divided by change in demand, right? B is still the same value here. Just this value here. Just this value.
Okay.
That is B.
6.6. 6.4.
No.
0.0004.
It's 0.004.
So 0.004.
So
based on
0.004. It's 3 zeros, sir.
0 into 3.
based on the question, that on the assumption that price stroke demand relationship is linear, derive the equation relating the selling price to the demand. So the selling price to demand, the equation would be what? Would be P is equal to what? 18.4 minus what? 0.000
0.0004.
Q. So this is the equation relating the selling price to the demand. P is equal to 18.4 minus 0.004 Q. So this is,
Sir,
please note.
sir, I thought we should define this Q now.
No, we are talking to people.
Don't worry, we are moving forward. You see a question where we'll define everything, don't worry. So let's take it gradually. Let's follow the question. Derive the equation, right? Relating the selling price to the demand. That is the question. Let's take it further. Let's take it further. Yes?
So I think can you please go to that slide, please? I think that 0.004 should be minus, it should be 18.4 minus 0.004p. When the bracket will be open, it will now be 18.4 whatsoever the
You said minus 0.004.
Yes, what I'm saying, from the B is change in price over change in quantity. And when we look at the change in price, one's supposed to have negative. And our B, our 0.004 should be negative. It's not supposed to be positive.
It depends on the calculator you use. If you use the calculator that says minus 0 in 4 places into 4, that's where you are going to get minus. But if you say 1 divided by 2005 is 0.000.
Please allow the lecturer to answer my question, please. Sir,
okay.
Saying, it's changing price over changing quantity. And whenever price is high, we have lower demand. So whenever price is low, we will have higher demand. So from the demand, there should be negative. It should be minus 2,500 because the up will be positive, the down will be negative. At the end of the day, our answer should be minus 0.004.
When the price falls, when the price increases, the quantity demanded falls, right?
Yes.
So on that basis, the quantity should be a negative, right?
Yes, the quantity should be negative minus 2,500.
Okay, it does not work that way, ma. It does not work that way. The approach is the change in price, you divide it by that change in quantity. Based on this question, when the price increased by $1, the quantity demanded falls by 2.5. So what is the effect of the price increase on the quantity? It means as price increases, the quantity falls by 2.5. So what is the relationship? It is $1 divided by 2.5. $1 divided by 2.5. When you divide $1 by 2.5, you have 0.004. 0.004.
It's okay, sir. Let's continue. It's okay. Let's continue.
So let's quickly look at this question. That a company currently has a demand for one of its products of 2,000 units at a selling price of $13 per unit. It has been determined that a reduction in selling price of $1 will result in additional sales of 100 units. The cost of production are $1,000 fixed, together with a variable cost of what? $20 per unit. Calculate the selling price per unit at which the profit will be maximized. Calculate the selling price per unit at which the profit will be maximized. So now, to solve this, we'll still apply the price equation, where P is equal to A plus minus BQ. So from this question, to solve for A, it will be what? The current price is what?
$30.
$30. Now, what will be the change?
100.
The change.
1/100.
So it will be 1 divided by what?
100.
Multiply by what? The current
2000.
actual
2000.
2000. 2000. So A will be what?
50.
50.
A will be
It's
50.
That is 30 minus, not plus.
A will be 50. Then B is what?
That's something for A. That's something for A. It's not minus. It's plus.
don't worry. That's also I don't have time. B is what?
30 minus bracket.
B is 1 divided by 100 equal to 0.01.
0.01.
So the value of P will now be what? 50
50 minus
minus
0.01.
50 minus 1 cube. 0.01 cube.
1 cube. Yes. Now, this is P. If we want to get total revenue, what are we going to do?
You can see by Q.
Total revenue will be what?
Times Q.
Price
P
multiplied
times
by
what?
quantity.
P times Q. Now, P is what in the question? 50 minus 0.01 Q, right?
Yes.
Yes.
So
Yes,
total revenue will be equal to what? Will be equal to
50
Q multiplied by 50 minus 0.01 Q. It will now be what?
50Q.
you open the bracket.
So total revenue will be equal to what? 50Q
50Q
minus what? 0.01 Q what?
Q raised to power 2. Raised to power 2.
Q to the power of 2. Do you see it? So this is total revenue. This is total revenue.
Sir, excuse me. Why do we use Q square? Because we have put 50Q minus 0.01 Q. I thought we need to collect the like times here instead of doing the Q square.
We are multiplying.
So we are multiplying. Price is what? Price is 0.01 Q. Quantity is what? Just Q. Q times 50 Q. Q times 0.01 Q, 0.01 Q squared. Now, this is total revenue. Now, if we want to get the marginal revenue, what will happen? We'll differentiate. I believe you should know differentiation and integration.
Yeah.
Yes.
So when you want to get the marginal revenue, you differentiate the total revenue to get what? The marginal revenue. Let me copy this. Marginal revenue is obtained by differentiating total revenue. So to get the marginal revenue, when you differentiate 50Q, it will be what?
50.
Okay, well, let me just do a little explanation of this. Differentiation means minus the power. The power of Q is what?
1.
1. So it's 1 minus 1.
Times.
Then 1 multiplied by 50. Do you understand?
50.
Let me just show it.
Yeah.
It's something like this. 1 times this. So when you do it, 1 minus 1 is what?
0.
Anything raised to the power of 0 is what?
1.
Indices. First law of indices
1.
is 1. Anything raised to the power of 0 is what? 1.
1.
So 1 times 50.
50.
1 times 50.
50 times 1.
50 times 150.
50. So this is it. So for this, to differentiate this, it will be what? 2 minus 1, right?
Yes.
2 minus 1. Then 2 multiplied by 0.01.
And 0.02.
So it will now be what?
0.02.
0.02. 2 minus 1. This power. 1. So it will be Q to the power of 1.
Sorry, why did we use 2 to multiply 0.01? I didn't get that. Sorry.
In differentiation, you multiply the main distance with indices.
Thank you.
Please let the lecturer explain.
Please, when you're done answering question, can you mute yourself?
So differentiation, there is a question, a recent question in the ICANN Pathfinder, I think May 2024, where there is a question they were solving. They applied the concept of differentiation, a question on regression analysis. So please, if you are not abreast with the concept of differentiation and integration, kindly do a revision on that. It's very important, so that when you see question, you'll be able to navigate. So if you're a business student, there is no how you must have come across differentiation and integration.
Sir,
Now,
please, can you give us a highlight, as in, because even me too, sir, I'm just confused. I'm confused currently. When this,
at what point?
Yes, because the way that you are explaining now, it's as if my brain want to knock concerning this this total revenue. So you are saying differentiation and integration. So you are using 1 to multiply 50Q and 2 to multiply 0.01Q. Please, can you expatiate on it, as in throw more light? Because at this point, I'm totally confused, as in lost, frankly speaking.
Anyway, even though I'm not a mathematics teacher, but the concept of mathematics is what is applicable here. So now, when it comes to integration, let me use a simple illustration. Let me use a simple illustration. For example, we have 2x. 2x, please take note. 2x. What is the power of x?
2.
1.
1. The power of x is 1. So if you want to differentiate, the power of x is 1. You less 1 from the power. It means X is having a power of 1. You less 1 from the power, you multiply the power of X by the value, by the coefficient now. Let me put it that way. Yes, by 1. So let me just show it. So this is an advanced mathematics. So in case, so X is having a power of 1. So 1 minus 1, if it is integration, it will be plus, not 1. If it is integration, it will be plus, not 1. But we are differentiating now. The concept of marginal revenue has to do with differentiation. So X is having the power of 1. So 1 minus 1 will give you what? 0.
0.
So you multiply this 1, this power, by this value 2. It will be 1 multiplied by what? 2. So 1 multiplied by 2 is what?
2.
2. So X to the power of 1 minus 1 will give you what?
0.
0. X to the power of 0 is what?
1.
1. So when you differentiate 2x, 2x will be what? 2. When you differentiate 2x, the differentiation is what? Is 2. We apply this concept here.
Now, wow. Hi.
So we've applied the concept of differentiation on total revenue. That's.
Please continue with the explanation. So talk about the other one that has 2 as power.
Sorry, I didn't get it. So the total revenue is what? Okay, let me show something. Total revenue. This is 50Q minus 0.01 Q square. Let's take note of that. So when you differentiate this 50Q, it will be what? 50. When you differentiate 0.01 Q square, it will be what? 0.02 Q. That is 2 minus 1. 2 multiplied by 0.01, you have what? 0.02 Q. Please, for you to understand this, if this is your first time of coming across differentiation, you have to do further studies on it. If not, there are various rules guiding this. So it is expected that as a business student, you have background knowledge of all this. So that is why the concept is coming. So now, to maximize profit, our marginal revenue will always be equal to our marginal cost. So marginal revenue is a point of profit maximization. That is, marginal revenue equal to marginal cost is a rule for profit maximization. So now, if our marginal revenue is 50 minus 0.0 Q, and we want to equate this to our marginal cost is same as variable cost. Please take note. Marginal revenue equal to marginal cost. Now, for us to get the price where we'll maximize profit and the quantity where we'll maximize profit, we'll have to equate our marginal revenue to our marginal cost. Now, if our marginal revenue is 50 minus 0.02 Q, Our marginal cost in the question will be what? Marginal cost. Marginal cost is same as variable cost.
$20.
$20.
$20. So equal to $20. So at this point, you collect your like times. You collect like times. And to do that, this will be 50 minus what? 20. When minus 0.02Q cross to the other side, it will be what? 0.0 what? 2. 0.0 Q. So you divide both sides by 0.02 Q to get the quantity. So Q will be what?
10.
Q will be what?
10.
10?
1,005.
Yes. So Q will be what? 1,500.
Yes, how did you get the 1,500?
30 divided by 0.02.
You have 1,500. Now, based on our, it's becoming tinier. Now, based on our price equation, the price equation is what? P is equal to what?
18.4 minus 0.004.
No.
Okay, no, 50 minus
0.01 Q.
So P equals.
Now,
minus
so to get the price where we maximize profit, P will be equal to what?
1,005.
50 minus 0.01. Q is what?
15.
So the price will be what?
50. Okay.
35, I think so.
35.
35 per unit.
35.
35 per unit. So the price where we maximize profit is 35 naira or dollar per unit. But we need to go further. We need to go further. What will be the maximum profit? The maximum profit. For you to get maximum profit, the concept of contribution must come to mind, because contribution is the value that covers for costs and profit. Now, in relation to this question, what will be your contribution?
Okay.
Our contribution
10.
will be variable minus selling price, which is 20 minus 35, which is 15.
So in relation to the units, to the unit, the optimum unit, which is 1.5, the contribution will be what?
35 minus 15. That's 20.
All right, let me just maximum profits. So we have it as a contribution. These concepts, we've been talking about this concept since when we started our discussion on PMD's diet. The concept that you always see in the exams. So contribution is 35 minus 20. So the overall contribution is what? Will be what? 22,500.
2,500.
Now, to get the profit, the fixed cost is given to us in the question.
Okay.
Fixed cost is given to us in the question as what? As the cost of production are $1,000 fixed. Yes, 1,000.
0.5.
So the fixed cost, when you less fixed cost from contribution, you have what?
21,500.
And what is that
One
thing?
five.
And what is that value called?
We have
To know.
we have
Profit.
profit.
It is called profit. It is called profit. It's called
Sir,
profit.
please, I have a question, sir.
All right, what is the question?
Sir, the P that we were looking for is called what? Okay,
The P.
when we say
P.
P, yes, when we say P equals to A minus BX, so that P down is called what?
Price.
The P is the price equation. Price
Is the
equation.
price.
Okay. I was thinking that the P is profit.
No, sir.
Thank you. Oh, thank you.
So the maximum profit is 21,500. Contribution is 15 multiplied by 35 minus 20. 15 multiplied by this 22,500. Fixed costs 1,000. The profit is 21,500. So there is a question we'll go and attempt. There's a question we need to attempt. Yes, this is the question. That at a selling price of $100 per unit, the company will sell 20,000 units per annum. For every $2 change in the selling price, the demand will change by 2,000 units. The costs comprise a fixed cost of 100,000 together with a variable cost of $5 per unit. Calculate the selling price per unit that will result in maximum profit per annum and the amount of that profit. Yes, and the amount of that profit. So
Please, can you go back to the last calculation, that P, where we did the solving of that P, please? Okay, thank you. Let me screenshot it. No, not that, not this one.
Kindly share it with me.
I'll share the slide with you so that I will not waste time. I'll share the slide with you. So please, I'll be sending questions to the platform on various topics that we've discussed on, because before I come up again on this platform to be by May, but we'll keep communicating via WhatsApp. So you can read on this, on pricing strategies, penetration pricing, pricing scheming, price scheming, product line pricing, complementary products, price discrimination, volume, discounting. Yes. So
Elisa, I have a question, please. I thought to get contribution, we say profit plus fixed costs. You're minusing.
It's minus.
I mean, I made a mistake.
if you want to get back this contribution, your
Yes.
profit is what?
My profit is okay. I don't have profit here. Okay.
Cost plus profit.
Don't worry. I thought that this thing was profit. Thank you. We don't have profit before.
All
I
right.
thought
Price.
So thank you very much. Maybe see you during the revision time again. So that's
Okay,
it.
thank you very much, sir. Thank you. Really appreciate it.
God bless
We will
you.
miss your presence. So
God bless you.
Thank
we will miss your
you.
presence.
God bless you.
Excuse me, sir.
Thank you, sir.
God
Hello,
bless
sir.
you,
Thank
sir.
you, sir.
Thank you, sir.
God bless you, sir. Thank you. I miss your presence.